Thank you very much for this introduction. Ladies and gentlemen, I should like to thank you for inviting me to speak to you today and for giving me the opportunity to visit Dublin since a long time again. The issue of a more strongly diversified banking market is one which I feel is well worth addressing, and one which I plan really to cover with my speech today. Now I would like to tell you something about the local retail banking market and the diversified banking market in Germany. My appeal would be for local retail banking. Now I have to get rid of this again. This works. So for smaller credit institutions, structured in the interest of a solid economic development, and importantly, for which there's a legal framework in place to prevent them from being incorporated into one of the big banks at the first opportunity. The German banking market comprises big banks, saving banks, and cooperative banks. These big banks may have famous names and international reputation, but in fact, it is the decentrally organized banking groups of the saving banks, Landesbanks, and cooperative banks that provide the majority of business financing in Germany. See how I come. And right. The Saving Banks Finance Group has roughly, you can see it here on the slide, roughly a 42% market share in business financing, of which more than 80% are medium to long-term loans. The saving banks have a more than 70% market share in loans to crafts and small businesses. And this segment is exclusively covered by saving banks and cooperative banks in Germany. And to add something, the saving banks are the prime partner for the state-owned KfW. They handed on state-backed promotional loans, for example, for startups, but assume part of the risks in their books, means in the balance sheet. This, however, only accounts to 10% of the saving bank's total lending to enterprises. Since 2008, from the onset of the financial crisis, saving banks have issued an increasing amount of new loans to enterprises every year. You see it on the right-hand side. In 2012, this were nearly 70 billion euros, a plus of 4.8%. These all are considerable numbers. However, each individual saving bank is rather small. The smallest has total assets of around 130 million euros. And most of the 417 saving banks have total assets of around 1 billion euro. So that means quite small and not huge banks. Each of the saving banks is an independent credit institution, means fully liable for its management decisions and deeply rooted in its region of operation. If you stand in a market square in any German city, you will see the classic trinity of the church, the town hall, and the main office of the local saving bank. This is typical for their day-to-day business. There is no hiding for customers in distant skyscrapers in Frankfurt or somewhere else. Saving banks fuel local economic cycles. The core of the business is converting local deposits into local loans. This means the size of loans that can be issued is determined by the amount of deposits available, with the result that there is little scope for artificial growth. Not only the loans but also the profits remain in the region. Saving banks divide their profits between their own reserves and spending for social purposes. It is in this interest of saving banks for their local communities to develop economically, as this is the only way to stimulate the circulation of deposits and loans, and those generate profits for the saving banks. For this reason, saving banks always look for long-term solutions in form of long-term customer relationships, conservative risk management, and for long-term predictable financing solutions for the customers. With long-term customer relationships means relationships which last sometimes over 3-4 generations. Saving banks are themselves structured like local enterprises. The 417 saving banks in Germany employ 245 million people. 19,000 apprentices and trainees are working for the saving banks finance group. They paid on an aggregate basis 2.7 billion euros in tax. Not to Berlin, but to municipal budgets of towns such as Itzehoe and Dinkelsbühl. Obviously, this money could be saved if one were based in the Cayman Islands. The question is where it is better invested. For clarification, I would like to add some things which saving banks are not. Saving banks are not non-profit organizations for non-commercial purposes. Saving banks in Germany are subject to the same regulatory requirements as all the other institutions. They are fully competitive and they live solely from the money that they themselves generate. But unlike other commercial banks, profit maximization at all costs is not the principal incentive. Moreover, their funding mandate, which is laid down in law and still applies today, requests a double bottom line. Saving banks should not only aim for profitability, they should also actively benefit society, which they do in 4 principal ways: to promote savings, through which the saving banks have a broad base of saving deposits, and this is a story of how they were growing in the 200 years of their existing. They provide a supply of credit to all sections of the population, which is all known as financial inclusion. And the third is they provide a supply of credit to small and medium-sized businesses, which is one of the core businesses of a saving bank. And fourth, the participation in regional development by sponsoring local social, educational, culture, and sporting incentives. Means that, no, it's not here in, the saving banks finance group with their single saving banks is the biggest sponsor in nearly every field in Germany. Not depends if somebody is learning the violin, if you are building up a kindergarten or renovating a church or a castle. Very important is the legal framework to make sure that this business model, including the founding mandate, is not weakened. An appropriate legal form is necessary. I would like to describe the example that we have in Germany for you. From a legal point of view, saving banks are institutions incorporated under public law. This term is often misleading, as it refers to the de facto legal independence of a saving bank. Neither the municipality nor the state have shares in a saving bank. There are no shares existing. As legally independent institutions, all saving banks make their own decisions about products, prices, and services locally, tailored to meet the local needs in the area where they are located. This local need also includes capital market-based products and security business. Saving banks' customers have no need for speculative interbank market products. Should a saving bank find itself in a financial difficulty, the neighboring saving bank would come to their assistance. For this purpose, we have a type of joint fund into which each institution pays, calculated according to the specific risk situation, the so-called joint liability scheme. This joint liability scheme is not an insurance. Preventative risk assessment is carried out regularly at all saving banks, and local management is fully accountable in bad times as well as in good times. I'm pleased to tell you that during the financial crisis, not a single saving bank has to be bailed out with taxpayer money. But on the other hand, for sure, if one of these saving banks would ask for help through the joint liability scheme, you can be sure that we would remove the management at once. I would also like to stress the importance of another element of the saving bank's legal framework, which I consider to be vital for all national economies with local banks, namely the regional principle. The regional principle states that a saving bank is only permitted to operate within the administrative area in which it was founded. Poaching from wealthy regions is not permitted. Means that if you are the saving bank in in Hamburg, and believing that the weather in Munich is much nicer, and therefore trying to open a branch in Munich, only because you heard that there are also living perhaps richer people as in Hamburg, then certainly you are not allowed to open a branch outside of your region. This is quite important of the structure of saving banks. In turn, the clear definition of business region enables the individual institution to achieve economies of scale and increase the competitiveness through the cooperation. For example, the 417 saving banks do have one mutual IT center throughout the group, through which resources are also pooled and the development of rating methods taking place for their corporate customers. We found out in our experience that defaults on loans to SMEs occur 30% less frequently than they do with larger exposures. So it's quite useful to build up this kind of risk management system. I come to a conclusion of what I was just trying to point out. German corporate customers have experienced no credit crunch during the years of the crisis. And also, there were banks which needed to be bailed out. Not one of them was a small local bank in Germany. I strongly believe that a diversified, decentralized banking structure underpins local growth and thus economic prosperity. Saving banks conduct the business they understand for people they know. Many thanks.
First of all, Jim, to you and your colleagues, ladies and gentlemen, thank you very much for the opportunity to come here this afternoon. I've been intrigued to observe the quality and relevance of the questions that you've been firing at Thomas Keidel. Just to explain a little bit of the background, the first thing I've got to admit is that I'm here by false pretenses, because if you think I'm a banker, then let me assure you absolutely that is not what I am. I'm an engineer. And I'm sure the thought is going through your mind, well, what the hell have they had to do with the German Sparkassen? And perhaps by way of introduction, I can explain a little of the background. My own background is much related to Germany, that of my colleagues. And they were aware that we do a lot of business in Germany. And the Director General of CIVITAS, which, as you perhaps know, is one of the major think tanks in London, phoned me up one day and said, we'd like to learn more about the German savings banks. And my response was, well, you're really phoning the wrong people. You need to talk to bankers or accountants, etc. And the response was, no. What we would like is an appraisal of the German savings banks seen from the perspective of industry rather than necessarily from the bankers. And that was how, with some trepidation, and certainly some rather adverse comments from my wife when I told her what we were about to undertake, we decided to go ahead. Now, The think tank CIVITAS is entirely independent, but has a very close interface with the British government. And when they commissioned us to undertake this report, it was in the expectation that it was fulfilled that the report would go directly to both the Treasury and to Vince Cable as some contribution to the debate that's taking place regarding not only the problems with banking, but more specifically, the acute problem that we're suffering in terms of providing funding to medium-sized companies. Now, I don't want to sidetrack too much, but having listened to Thomas's excellent presentation and heard some of the questions, it occurred to me it might be sensible just for a couple of minutes if I talk a little about German history, the structure of Germany, and the structure of German business, because I think that may help to provide a framework to understand perhaps a little more clearly how it is that the German savings banks are able to operate in the form that they do at the moment, and have indeed done for since the 18th century. The first comment is that Germany is an extraordinarily young country. It has only existed since 1871, and it is organized on a federal basis. So that means that, seen from an Irish perspective or a British perspective, many of the functions that you would anticipate would be the responsibility of the central government are in fact the responsibility of the individual states. As Thomas said, the lender, the 16 lender. Now, these lender are highly independent. They carry out, have responsibility for things like health, education, etc., which you would think will be centralized. And of course, they also have a tax-raising capacity as well. So when Thomas is talking about the top tax contributions from the savings banks, these are going into the states and into the local municipalities, not into the central state as we would understand it. The other thing that I want to say is that there is a perception that the strength of German industry is all about the Siemens, the Bosch, the Mercedes, the Daimlers, etc. When you look at the numbers, the absolute opposite applies, that over 50% of the total revenue generated by German industry comes from small and medium-sized companies. That, just one other very simple statistic, 99% of all German companies have a turnover of less than 10 million. Because there may be a feeling from an Irish perspective, well, you know, this very large, economic, powerful country, very large companies, how can that possibly relate? But if you go away with nothing else today, it's that understanding that the savings banks are there primarily to support these small and medium-sized companies. I hope, Jim, I haven't sidetracked too far, but it may be perhaps helpful in terms of just understanding a little. The other, Thomas, if I may be permitted to say, with respect to the umbrella organization, the Verband, this only operates by approval and permission of the individual Sparkassen. They are not there to direct. The people who make the decisions within the Verband, the umbrella organization, are the representatives of the individual savings banks. So they are providing that very important IT back office function. They also exercise a phenomenally efficient control mechanism, not in any way to breach that total concept of autonomy of the individual bank, but to make sure by common consent that there is never realistically any danger of any individual savings bank falling into default. So that was something of a sidetrack, but I hope that it may perhaps provide a little of the background further. This is just simply me repeating again the words that I've used already. With respect to the commission that we had from the CIVITAS, it was initially a request that we undertook an assignment to make a study of the savings banks. And we were well advanced in doing that when CIVITAS came back to us and said, would it be possible to undertake, in parallel with this, the production of some case studies? We had quite a difficult task in that it was fundamentally important that we were not only independent of the Sparkasse in terms of carrying out this appraisal, but we were seen to be independent. But of course we couldn't do it without the cooperation of Dr. Keidel and his colleagues. Anyway, as Thomas will remember, I went back to Berlin some way into the project and saw senior colleagues, and I said, would there be any possibility that you would give us approval to sit in on live negotiations so that we could get a first-hand impression of what the general atmosphere is, what are the important criteria when a company goes to a Sparkasse and makes an application for funding. And you'll remember the comment, Thomas. I heard the response in German, Mr. Simpson, nobody has ever asked us this before. But after some consideration, they said, yes, subject to, obviously, conditions of total confidentiality, they would allow us to go to individual Sparkasse around the country and actually sit in on live negotiations. So there is a report, and I have copies here, and you're very welcome to help yourself. You'll see it is in two parts. The first is the commentary, and the second is a case study from one of the exercises that we undertook. Now, if you look at it from the perspective of the UK, and I rather anticipate that much of this will be very familiar to you here in Ireland, that we've been suffering a huge current account deficit. To give you some indication, the UK is running a balance of payments deficit of about 90 billion on manufactured goods, which is offset by about 30 million from the service and banking sector. So we're running a net 60 billion. Sorry, is it difficult to hear?
We can't hear you.
I'm sorry, I beg your pardon. We're running something like a 60 billion deficit, which has been funded essentially by sale of capital assets, and the government recognised this is an unsustainable situation. And where my particular interest lies, and perhaps one of the reasons why CIVITAS approached us in the first place, is that in any modern economy, if you're going to compete internationally, you have to make sure that you're investing at a level both in terms of production, plant and machinery, but even more importantly in terms of training of the people, at a level that relates to our international competitors. And certainly the UK has failed to do that. But of course you'll appreciate the dichotomy of how do you raise investment levels when the banks are going in exactly the opposite direction and trying to reduce lending. So the climate now is one where all of the political parties recognise that one of the fundamental essentials is to improve the efficiency and output of the manufacturing sector, particularly relating to the SMEs. And as I've said, that was the driving factor behind the commission from CIVITAS. Now, it's certainly not my intention to go over the ground that Thomas has very effectively covered already today. But I would just like to quote one section from the report that we wrote, and I feel it has sufficient importance just to take the time of reading it through for you. The remarkable success of the German industrial Mittelstand in the last 60 years is directly related to the financial and overall economic support that has been provided by the German Sparkassen. In terms of structure, organisation, operation and definition of responsibility, seen from an Anglo-American perspective, they are unique. They provide not just finance, but are obligated by their constitution to support the sustainable development of the total economy within the defined geographic area, as Thomas has illustrated, and the fact that they also have this very significant social responsibility that goes well beyond the provision of banking services. We've heard already about the public mandate. The fact that they're credit institutions operating under law, and the fact, as Thomas very effectively explained, that they are entities under law but not owned by anybody. And it's quite a little difficult to get your head around that. I certainly found it a problem. But it's remarkable how well and effectively it works in practice. And as you can see, the remit is to provide money and credit services to customers, and also with particular emphasis on the medium-sized, smaller businesses. Promote savings to strengthen competition based on the competitive requirements of the business area. And as Thomas has more than adequately explained, where the surpluses go, and the fact that they are very much constrained, or absolutely constrained in terms of operating within their own defined geographic area. The stability is a very important factor. In practical terms, in terms of giving confidence to their customers. They've been around a long time. From the experience we gained of this study, it is quite remarkable the level of understanding that the local management of a savings bank has with its customers. I found instances where they say, well, we went to school together. And although they have very sophisticated credit controls, I came very clearly to the conclusion that the reason that they have so low write-offs, bad debts, is primarily because of this level of confidence that exists between the savings bank and their customer. If I may be impertinent enough to just make a few observations regarding the Irish economy, and I would stress this was simply because I felt that if I was going to get on my hind legs here, I ought to at least make some effort to understand in a little better detail what the situation is in Ireland at the moment. And obviously it's very clear that there's a problem with the availability of funding, and as a consequence of that, very low levels of investment. And as I've already referred to, this dichotomy between the balance sheet strengthening and, on the other hand, trying to improve lending. And I think that perhaps one can conclude that any solution is not going to be a question of fiddling around at the edges. If there's going to be any radical improvement, then it's going to be by very fundamental changes. And again, echoing some of the responses that we've had from certain parts of the government in the UK, where the feeling was that the solution is just simply set up another national bank, London-based, I'm profoundly persuaded on the basis of the experience that we generated with the savings banks that that is not the solution, and that the way to go is in terms of local banks, autonomous, locally managed, local responsibilities. This again, I'm going to go through this fairly quickly because, as I said, it was really for my own benefit just to get a fix as to where the Irish economy was, and I benched this against the performance in Germany and in the UK, and as one can see very graphically from this, if we've got a problem of underinvestment in the UK, then certainly you've got one here in Ireland. These are pictures more or less showing the same thing, but what I find quite extraordinary from this is when you talked about boom years, they certainly were, but like the proverbial rocket, it's gone down even faster than it went up. And I think it's not my job to comment about the Irish economy. I'm not here to do that. But it is apparent that from the statistics that there's very little sign of an upturn, whereas both in Germany and the UK, we seem to be going in the right direction. Now, I'm going to go through some of these other even more quickly. This is another picture saying more or less the same thing. But if you think that we can start to feel rather overconfident in the UK in terms of what's happening, well, just look at the position in terms of lending. It's going nowhere. It's just an absolutely awful picture, and can only underscore that that both the UK and Ireland are very much in the same boat in terms of finding means to get the investment levels up. What you will see in a moment is evidence that the willingness of the German savings banks to provide additional funding at that critical time when the recession hit Germany. And one thing I would say with as much conviction as I can, that when the recession hit 2008, 2009, if you think it was tough in Ireland, it was very, very tough in Germany as well, for the simple reason that although it was a powerful economy, that economy is dependent on exports. And there was such a huge drop in exports, and it meant that the country went through a very anxious period. It's not a topic for today, but on another occasion it will be good to be able to talk about what the government did in terms of supporting small businesses, and particularly the immediate reaction they had to provide to support to companies who were otherwise going to lay off people, to provide in cash terms support to keep those people employed. This is the picture that Thomas Keidel showed earlier. I really need comment no further. But what perhaps you can see here is the consequence of making that funding available. That looking at it in GDP per capita basis, you can see that Germany came out of the recession at a phenomenally quick rate. And the reason for it was that they managed to keep their skilled people. And further, there was a remarkable determination, both at government level and within individual companies, to hold tight. And in fact, the level of investment in R&D actually went up in the middle of the recession, which I think is quite an extraordinary achievement. So the fact that it's climbing now so rapidly out of the recession, it's relatively easy to explain. Now, for my own benefit, and I'm going to go through this very, very quickly indeed, I just wanted to get a fix, and Eurostat is the European Union Statistics Department, and so I realised that they've been taking some surveys regarding the whole aspect of financial resources. And what I'm going to suggest is, rather than talking in detail, because I'm anxious not to go on too long, there will be a copy of this available. And for those of you who are interested, you may want to look at this in a little more detail. And there's 4 or 5 slides here, and you can draw your own observations from this. It's a picture really where, in some ways, there is a lot of commonality in terms of the response to the survey, but also some fundamental differences. And you can see, not least in terms of the overall perception of where the relative economies are, that top line. This is also perhaps some indication of the success for those companies who are applying for funding. And in this case, it's obviously split up in terms of the potential sources for that funding. And again, there's some detailed observations from the Eurostat survey in terms of the failure to gain finance. And this one finally is looking at the ownership by enterprise. And there are some quite interesting differences here. If you look at the sole proprietorship, and it perhaps reinforces the comments I made earlier about the influence of the German Mittelstand, the small and medium-sized companies, in terms of the overall economy. There is a huge contrast there between both Ireland and indeed the UK in that respect. So I'm going to come to a fairly rapid conclusion now, and just try and summarise that what I see as being the key elements with respect to the savings banks. They provide not just finance, but are obligated by their constitution to support the development of the local economy. They have very significant social responsibilities. They're entirely reliant on their ability to generate profits, which are then transferred to reserves. If I could just make an observation. When I talked to people in the UK and told them that we are undertaking this assignment to review the savings banks, I heard from a number of people, that's interesting, and there was an influence that this is really a pretty backwards operation, that they're under far less pressure than commercial organisations. What I found is the very reverse of that, that they are indeed extraordinarily professional. The quality of the management at the local level is quite extraordinarily high. The back office operations, I would argue, are probably as good, if not better, than any other international bank. And critically, although, as I've emphasised strongly already, the savings banks are entirely autonomous, by consent, they have a formidably effective monitoring system, it's almost what you call the traffic light system. And the whole idea is they don't in any way interfere with the conduct of the business. But by agreement, all of the savings banks report back to the central body on a consistent basis. And they monitor the key statistics, the key ratios, with extraordinary effectiveness. And as soon as they can pick out something which is outside the norm, then there is action taken. And then as it graduates, and when Thomas made the comment that if anybody transgresses, all I can say is the reaction is draconian. I've never experienced something where we have bankers who go out of line and they pocket their millions and buy their yacht in the Mediterranean. That doesn't happen with somebody who is regarded as not acting with appropriate responsibility with a savings bank. So there is a real edge behind this, to think that they're just simply organisations there for the general good, and there's not really very much tight control. It is in fact the very opposite in terms of the impressions and the information that we gained. I've already talked about the relationship with the bank, between the bank and the customers. I'm just going to relate, if I may, one anecdote. Thomas, it was when we were in Stuttgart. Remind me the name of the Sparkasse that we were there. Yeah, no, not in Ulm, the other one. Yeah, Weiblingen. And I had an opportunity to talk to the director who's responsible for credit control. And I said to him, I've been, and it was genuine, very impressed by what I've seen. But tell me, what happens when you have a case, what you might describe as a no-hope case, where the business has reached a stage where it's very difficult to see any way out? And he paused for a moment, and then he said to me, Mr. Simpson, before I answer in more detail, the first thing that you need to understand is in those sort of circumstances, the probability is that 50% of the employees will have their current accounts with us. So you can see that although there is no element of a soft touch, because of the way in which the banks are structured, they will go to extraordinary lengths to make sure that they give support to that company and come out of it. And if you're interested and have an opportunity, there is a case study in the report where we looked in detail at a company which certainly in terms of UK context, you'd have thought, well, the first thing that the banks are going to do is draw in their loans. And I'll leave you, if you're interested, to see the results of what in terms ultimately happened. So I hope I haven't gone on too long. Thank you for listening.